because the seats do fill up fast. Welcome, welcome. Some more people just jumped in.
Algenia from Georgia.
Welcome, Algenia.
Derek, Houston, Texas.
Welcome, Derek. I'm sorry, Jarek.
Leslie, South Carolina.
Welcome, Leslie.
Cleve from Georgia.
Welcome, Cleve.
Erica Neal, Puerto Rico.
Welcome, Erica.
Thanks, Chris.
Charity from Germany.
Welcome, Charity.
Sam Bean calling for witness protection.
Welcome, Sam.
What is this? The computers is going crazy.
Oh, man. Sam is in hiding. Welcome, welcome. I think I just saw Mr. Pacheco join. Oh, there we go. Welcome, welcome. All right, Sam, I think we got the two most important people on.
Good morning.
Good morning, Mr. Pacheco.
How's it going? How's everybody doing today?
Great. Let's get
Fantastic.
this.
Recording in progress.
Sam, you want to take over?
No, go ahead. I can set up. What do you think?
All right. Well, everyone, as we always do on these Thursdays mornings, we try and gather here to teach, to grow your team. This Thursday is a little bit different. We got a lot of requests for information on our Algo Alpha platform, setting it up. We wanted to do a Q&A, so Mr. Pacheco said, let's get on Thursday morning. Let's get as many people as we can on the call so that we can go through and show you the portal, some settings, do a Q&A. So we answer all your questions, as the last couple of weeks with the things that are happening in the world. Some people have been questioning, why is this happening with the portal? Why is this happening? So we wanted to make some time to clarify that and go over some information. And we'll also be doing some more trainings in Circle. So keep an eye out on some more videos and information in Circle to give you more clarity of our algorithm platform that helps you with trading. So without any further ado, I'm going to hand the mic over to Mr. Pacheco, and he can take over the training from here. Make sure you put yourself in a position where you're not distracted, because usually when that happens, questions pop up that are covered on these trainings. So this is a very important training. So make sure you're paying attention. You got a pen and pencil, and you're focused on listening into what Mr. Pacheco is going to be going over.
Well, thank you for that, Chris, and good morning to everybody. Good morning, Sam. Good morning, everybody that's on here, Barbie and Tim and all the usual suspects here. If I miss anybody, I'm traveling right now. I'm on my laptop, and this is a 2019 laptop. And as I was trying to put together some slides for this morning, I realized I need to upgrade my laptop here because it's absolutely imperative that I upgrade. So that being said, if we lose reception, I'm in Vegas right now. I was at the mine, and surprisingly, our internet at the mine is better than the internet in this hotel. I'm over here at the Crockford, I think this is called, over in Resort World. So if we lose connection for any reason, I do apologize. I did upgrade and buy the supposedly faster internet, but I see that's a little choppy. But hopefully you guys could hear me okay. Can you guys hear okay and see the screen okay?
Yes, sir.
Okay, wonderful. All right, so let's get started. And I'd like to get started by sharing my screen here. And we're going to go. The very first thing that we want to do is I want to share. I'm going to go here. Let's open up a window and we're going to go ahead and go to build network. So our training here today is going to start in an area where, maybe some of you are familiar with this, maybe you're not. And so we want to make sure this kind of skipped everything and just kind of threw me in here, but let me see. Put it into, is it in English? Where do I go to? Oh, here we go. I'm in Spanish mode here, but we'll go to English. So we're going to click here on Premiere. We're going to scroll down. Now, if you're in the Elite, it'll be, for you, it'll say Elite. If you're in Premiere, it'll say Premiere. Now, if you're not in either one of those, then you're not going to be able to get to what I'm about to show you. So you would have to upgrade your account to Elite status or Premier status. But if you go here to the Build Academy Access, you're going to be able to see a lot of different courses, a lot of different things, a lot of training on a lot of areas of the company, from the Home Essentials to the Smart Money Club, Smart Money Feed, all of these different things, right? So you have a lot of tools, you have a lot of different things, courses, etc. Now, for today, I'm going to go down and scroll to where it says Trading Tools Courses. So you see here, you see Algo Alpha X, and that's fine. That's actually to set it up, right? This is to set up the account. But when you go down to the tools, this is going to open up to a lot of content. And so the content that's here, and again, I don't know how many people here are familiar with all of this, but there are some that are absolutely imperative for you to go through. I think you should, take the time and go through all of these. The longest one is this one here, which is a full onboarding walkthrough, which is about an hour and 23 minutes. However, for the purposes of today, some of the things that we're going to cover, if you notice, this is a 5-minute video, 5:21. This one over here is 10 minutes, right? And so these are very, very important, these two videos here. And not to say that everything else is not, but I would, taking the time when you have time to go through this, you can get through this in about an hour and 45 minutes, right? You're done. Now, this is really good education for everybody that's trading with algos. Now, remember, your membership here at Build includes not just the algos, but full blown out education. So the algos is just a piece of it. However, the monthly fee covers everything that has to do with everything trading related and everything company related. So when you're paying that membership, it's not just for one particular product line. It's actually encompasses everything that the company has to offer. So this is back here. It's been back here. If you're unaware of it, that's fine. Not a big deal. But when we look at this particular video, right? And I'm not going to play the video because it'd be kind of hard to do so. But when you look at that in the Word document that it's going off of, whether it's this one or this one, in fact, this one right here, we're going to go ahead and take a look at this in real time. So I'm going to go ahead and bring that up. And if you can see my screen, you should still be able to see the document. So instead of having to watch the video, here's the document that the video is about. And so we're going to be covering some of the things that are on this particular document. So now remember, all of this is in your back office. If you're in elite status or premier status, I already showed you how to get to the information. But for the purposes of this training, we're just going to go off of the actual form. That was the content that was recorded there. So it's it gives you kind of a little bit of an overview on the different types of strategies that we have. All in all, if you're an elite member, you have 3 different strategies to choose from. And if you're a premier, you have 7 different strategies to choose from, or up to 7 strategies to choose from. So it kind of tells you a little bit more about what type of accounts for whatever it is that you're trying to accomplish through your risk tolerance. And we're going to be going back to risk tolerance throughout this training here. Now, risk settings. This document will break down the overview of the risk settings component of the platform. Default out of the box and what all clients are set to upon activation is shown below. So this is the first one, right? Now, when you look at this, the risk settings out of the box, if you are at an account size of 3,000 plus, this is going to be the risk setting right out of the box. Now, this is important and only applies to the people that have a balance below 3,000. Now, below 3,000, this is something that you want to check in your settings. Now, when you open up the account in the form that actually, I'm assuming here everybody's already gone through the form. But if not, put it in the chat and I'll show you where in the back office you can grab that form and fill it out and do the whole thing. But the risk type will be different for you, okay? And I actually have it right here. I took a snapshot of the video and I could actually take you into the environment in just a second, but it would do me no good because my account with the Gold Alpha is actually direct to the master account of the provider. So it doesn't even, I kind of bypassed the Algo Alpha environment, even though my account does show up there. But for me to actually change any settings on it, it's actually in a different system. So, but I'm going to go right here to this PowerPoint real quick. And I'm going to show you what that would look like. Let's see here. So if you can still see my screen, please put it in the chat. I'm going to bring this up and play it. So if you have a balance of 3,000 or less, 2,000, 2,500, all the way up to 3,000, let me just check the chat here real quick. Make sure you guys are able to see. Okay, perfect. Thank you. Appreciate that. Your risk type setting should be lot multiplier, and then here there would be a 1. Okay, so it's going to be lot multiplier 1. Now, what that means is the account is going to mirror the sizing, position sizing, and the trading that a $2,000 master account is actually taking. So when this is set to lot multiplier 1, then your account is going to mirror off of a $2,000 account that is set up for it to ping all of the users' accounts on the copy trader. Now, that works the same way with accounts that are above 3,000. The only difference is that those are going to have the other setting that the document says, which is by balance, right? So the multiplier by balance is basically saying that because there's more margin in that account or there's more money in that account, you could use that setting, which automatically is going to scale up without you having to do anything. So as you're earning more, or if you deposit more and that account, is higher, then it's going to adjust automatically to position sizes. And so, but if you're below 3,000, then the risk type should be lot multiplier 1. Now, because of this, we're going to have some adjusting, right? Most of these accounts are already set up that way, but if you log into your Algo Alpha dashboard, just make sure if your account balance is less than 3,000, make sure that this is lot multiplier 1. Now, everybody coming out that's brand new, or any new sales that are coming out, this is already set up for them at this depending on their account balance. And so right out of the box, this is what most people are going to have. Now, we do have, or Algo Alpha does have a different clientele, right? They have, you know, uh, I can actually show it to you. We have somebody that's interested right now that has $250,000 to deploy into the different strategies that we have. But anyway, that's a different story. But let me go back to the actual, let me see, let me escape from here. And we're going to go back to that document that I was showing earlier. And here it is. Okay, so if your account balance is higher than 3,000, then the risk multiplier by balance is the correct setting that you should be on. Now, users can adjust the settings at any time, but the following conditions should be considered. Okay. The account type. Okay. What does this mean? Well, there's straight equity. What does straight equity mean? Very simple. If you have $10,000 that you deposit, that is your equity, 10,000. So it's a standard account or a straight equity account. Now, a funded account are the types of accounts that are 10x. So there are people here that have used or are on Algo Alpha X. And so that one uses a particular type of account, which is a GNT funded account. Okay. And so I'll show you what that looks like here in just a sec. Let's see here. We're going to log in over here. And well, actually, we're going to log out of this account. We're going to go to another account, which is this one. And this account is on a GNTX funded account. So what this means is that whatever balance was there, the equity attached to it, 10x. So this account started with $5,000. So it 10x the account to 50,000 and change. And so that's what that means. So the money deposited into the account was 5,000, but because the broker is funding, quote unquote, funding the account with an extra 10x. So it's going to 10x whatever you deposit, whether it's 2,000, 3,000, 10,000, whatever it is, it's going to 10x that account. And so that is the difference on the account types. So when you're looking at those settings of risk by balance, or you're looking at by lot multiplier, then another consideration is also looking at what the account type is. So straight equity, 100% of your deposit is what's being traded. With a straight equity account, risk-adjusted settings are welcome as users have less restraints relative to funded accounts. If you're on a funded account, then your funded accounts, meaning account equity, is only 10% of the trading balance. So it allows you to get into bigger positions and in more positions, because it's giving you that room to be able to trade outside of the confines of the account balance that you deposited, but that's only going to represent 10% of what the trading balance is. So that can be it can be risky, right? Because you're leveraging a lot more money than what you actually deposited. So when you take the losses, that's going to be proportionate to the losses as well. Now, with funded accounts, it's important to understand the implications as to below of each of the following settings, and it's on our users to set adjustments as they see fit. So out of the box, okay, out of the box, you have the settings, but ultimately it's important for you to go through all of the education that's on there so that you can manage your account in whatever way you wish to. Because the default settings, risk type will automatically adjust the trade sizes as the balance increases. This allows a mirroring of percentage returns presented in our master accounts to the relative risk reward. The hypothetical table below illustrates the risk type settings. So if a client deposits 10,000 into a brokerage, then the adjustment for positioning on 10,000 would be 0.1 lot size for each trade. Client deposits 100,000 into a brokerage, then you're looking at one lot size for each trade. So what that simply means is that right out of the box, it's going to adjust without you having to do anything to the account balances when the multiplier is set to by balance. On the smaller ones, we don't want it to do that because it's a small account. So it's mirroring off of a $2,000 account so that it can trade according to the balance that's there without adjusting higher. Now, that doesn't mean it's not going to take higher positionings, and we're going to get to that topic in just a second because I know that that's a little bit confusing for a lot of people, and we'll cover it in just a second. What I'm saying is that it's going to follow on 2,000 on 0.01 versus on 10,000 0.1 or on 100,000 0.1, right? So, which is what you're, excuse me, one lot size for each trade. So that's what we're talking about. Now, the risk multiplier overview, okay? This setting allows you to control how aggressively or conservatively the algorithm treats on your account. Now, so there is a setting, right, in the risk multiplier that you can change. It's set to 1. However, that can be adjusted up or down depending on what your goals are. So the setting is at 1, but you could actually increase it. And I've seen people do this. In fact, one of my very dear friends who had deposited about $120,000 or $130,000 into his trading account, found out about these settings and he asked me about them. I said, yeah, if you increase them, you could make more money, but you could also lose more money. And so this is important for you to understand that if you start moving these settings, okay, there are consequences to that, right? They could be good or they could be adverse. And so if you want to adjust that and you're adjusting it on a straight equity account, that's one thing. But if you adjust those settings on a funded account, that's quite, it's very different, right? Because you're already using a lot of leverage, and then to move these could be a home run or it could be something super detrimental. And so unless you're a seasoned trader and understand risk management, understand account balances and all of that and how all that works, I would strongly encourage you to do your due diligence, really look at this and make sure that you know what you're doing before you do it. So if you set it to 2, for example, if you go from 1 to 2, you take twice the risk and twice the potential return. Now, on a funded account, in my book, that is way too high because you're already trading on a funded 10x account. And so when your actual equity into that account is only 10% of the account, well, this could be very, very detrimental. So 0.5, if you bring it down to 0.5, then you take half the risk and half the potential return. So that's how that works. Now, this is important. The setting does not manually double or halve lot sizes in a simple way. Instead, it proportionally adjusts position sizing, stop loss distance, and overall exposure per trade. Now, this is not in response to some of the questions that I'm sure we're going to get about position sizing. This has to do with the settings that we have control over, not the actual strategy that we're trading. So each strategy has its own rules. The Alpha X has its own rules. The Algo Alpha has another one. The Intelligent Portfolio has another logic, if you will, that's programmed into it. The Crypto Alpha has a different logic that's built into it. And the Gold Alpha has its own logic that's built into it. So this is on top of all of that, each system has whatever logic it is and whatever it does automatically. On top of that, you have this layer of what we can control on our end through the copy trader software. And so I'm only talking about the copy trader software settings at this particular point. And I want to do that because these are some of the settings that we do have control over and above what the system does or doesn't do. So stop loss and return impact, the risk multiplier, if you change those, trades use wider exposure, drawdowns can be larger, potential returns are higher, it's more aggressive growth profile. Risk multiplier by half of the setting, if you take it down, trades use tighter exposure, smaller drawdowns, lower volatility, and more conservative growth profile. So the wider the larger the setting is, the more room there is to potentially capture profit. When you bring it down to half, then you're actually tightening it up, and this is going to be a good lead in to one of the settings that we want to talk about. And so we're going to go into, maybe I have it already up here. Nope. Where is it? Give me 1 second, please. I'm usually at home when I do anything like this, so I like that way better. But here we are. All right. So we're going to go into this dashboard, and we're going to log in. And it looks like I'm already logged in here. And we have, we're going to pick this one. Here's why. If I pick this one here, I'm not going to be able to show you what I want to show you right now. I don't believe. Well, let me see. Maybe I can. So I'll pick this one. And took a loss today. I was up and then I took a loss. All right, so let's see here. Where am I trying to go? I'm trying to go here to the configurator. Let's see. There we go. Equity monitors. Okay. So if you notice, there are no equity monitor set up. Now, is it a good idea to set up an equity monitor? It depends on the individual. It depends on risk tolerance. It depends on account size. It depends on many different factors. It depends on whether we're in wartime or peacetime, or if it's normal market conditions, or the new supreme leader of Iran just said that they're going to run up each barrel of oil to 200 a barrel earlier today, and sends the market into a tailspin once again. So, and this is, I think let me see, was I reading that earlier? Where was that? Was it here? Here? I don't know. I was looking at the news, and maybe it's here. I don't know. Here? Yeah, I was looking at the crude oil price, and the threat was that they're gonna, shoot up each barrel of crude oil to 200. And if that happens, how does that affect us here in America? And looks like the average price would be about $7 a gallon. So that's not a small thing, right? So when you look at those events and you're looking at the market that we're actually in, we're not in a normal market. And so some of the recent losses that this particular um, uh, product has taken has been a direct result of the war that's happening right now. And so once these, missiles get fired off, or an announcement like today's announcement, it sends the market into a tailspin. So is it a good idea to have an equity monitor? Well, maybe so. I think that it's not a bad idea. So right now, most of the accounts that are out there have had, let's see. So if I select this one here, select the type, and just to review here, target value, this is where they can send you notifications if you actually hit a particular target increase on your account, or a certain percentage that your account has grown, then you could get notifications on that. But most of the time, this is used for protecting value, right? To protect your account. Protect percentage is usually the one that we're going to do. So I'll select that. So if I wanted to add this right here, then I would say, okay, well, what is my risk tolerance, right? And so that's going to vary. And that's why we could set a 20% percentage here, which we would do it this way. It's actually in reverse. You would put 80% right here, which would basically say, okay, well, if you lose 20%, then it's going to protect 80% of your capital. And that's how this would work. So instead of putting 20% here, you would put 80%, because if you put 20% here, and this is important, guys, if you put 20% here, then it means that you're effectively you're basically saying that you're willing to take an 80% loss on your account before you shut it off and shut off all positions. And so you want to get this right if you're going to use this. If you put protect percentage is 80%, that means that if my account balance falls below 20% at any given time, it's going to close out all positions and just get me out of those trades. So you would select the action down here, email alert, disable copiers, and close open trades. That's the correct setting. If I wanted to add this equity monitor, if you notice, there's no equity monitors set up. I'm not recommending one or the other. Okay. I preface this saying, look, this particular product hadn't lost a month, and it still hasn't, because a month isn't over, but it hadn't lost a month in 14 months. So to give it room to do what it can do, I decided not to put any equity monitors. Maybe I'm going to kick myself later. I don't know. But I took a loss just like everybody else. My account was at 10.8 when, it was at 10.5 when I got on the plane. And then it was at 10.8. No, excuse me, it was at 10.8 when I got on the plane to Utah last week. When I got off of the plane, I was at 5,100. So that was what it was on Friday. As of this morning, it was at 5,400. So it had made about $100 a day in a very choppy market. And then today we got hit with a loss of $400. So these are not normal conditions by any standards. So I started to do research why, and sure enough, I find the news event of the day, right? They're destroying some trade, or they're attacking some trade routes, and threatening, the prices of oil to go to 200 barrel versus the average, which has been around 88. So when you look at something more than doubling, yeah, it's going to send the market in a tailspin. So now, should I have had one of these 20% on the account? Well, if I had it, it wouldn't have triggered anyway, because on a $5,000 or $5,400 account, the 20% is about 1,000 and change, right? So it would have been triggered anyway. I would have still taken the loss. Now, if your account balance had been 2,000 and you took a $400 loss, which it probably wasn't going to be a $400 loss because your positioning would have been different. But let's say it was $400, right? And you're at 2,000, then that's going to bring your account down to an amount that is not tradable anymore, because you need a margin of 2,000 to be able to trade. And so that's where all of these considerations matter. And again, we don't want to make that decision for you. I mean, out of the box, it comes with some standard settings. Keeping in mind, 20% is a pretty standard number of risk tolerance, but that's an arbitrary number, right? You have full control of your account and saying, hey, I'll take a 50% drawdown, or I'll take a 5%. If my account goes under 5% in a day, I'm out. Or 10%. What that number is going to be different for everyone. But this is where you set those percentages up. If I want to protect 90% of my account, then I put 90. If I want to protect 50% of my account and I'm comfortable with that, I'm going to put 50%, and so on and so forth. So that's what this is for. So now we've covered the account types: funded or equity. Equity just means it's a standard account, dollar for dollar. Whatever you put in is what it is. A funded account is one of the accounts that are 10x. We talked a little bit about the risk multiplier. The risk multiplier is going to affect the account positively or negatively, depending on how you set it. If you cut it in half from 1 to 0.5, then it's going to be more conservative. If you increase it to 1.5 or 2, then it's going to, affect proportionately to doubling your risk and doubling the reward. So and then we covered how to protect your account capital. So these are the main things that I would really consider being educated on, and hopefully you now realize the importance of this, because when you look at this sheet here, and we're going back to the sheet here, when you decrease that risk multiplier, the risk level now becomes very conservative. Volatility is low. Minimum deposits are higher. Stability and preservation. I know that doesn't sound like it should be that way, but it is that way. So it sounds like this should be lower, but no, it's actually higher. But it allows you to be a lot more conservative. At 1, the standard, it's medium, it's normal, balanced growth. And at 2, this is very aggressive, high risk or high volatility. Minimum deposits are lower, but the losses could wipe you out. Faster growth, higher swings. Yes, you can make more money, but you can also get wiped out pretty quickly. When you go the other way, you go to 0.25 or 0.5, it's the exact opposite, right? So, and this is all in your back office. You can watch videos on this, very, very detailed videos on this as well. Now, last thing that I want to show you, I think we already get this. Let's see. Well, this is good to review. So when you move the risk multiplier from 1 to 1.25, small losing streaks hurt more. So if this was at 0.25 on a straight equity account instead of 1, if we're already hurting at 1, it would have hurt more if you had increased by 0.25. Now, if you would have been in January and February and you put that to 0.25, that 50% growth on your account, or 56% in February, or 35% in December, or 15% in November, well, guess what? It would have been that much sweeter had it would have been over and above those numbers if you had increased it by 0.25. So there's the good and then there's the bad. Now we're talking about pre-war, it would have been phenomenal. But right now, if we're hurting at 1, right, because everybody's set at 1 right now, if you move that to 0.25, it would hurt more. So small losing streaks would hurt more. 1.5, hang on, my beautiful wife is distracting me right now. Yes. Okay. I don't know. She's like moving around here, so she's distracting me. Okay. Now, if you moved it to 0.5, normal volatility feels extreme. We're already feeling that. So right now would not be the time to be increasing your multiplier. At 2, fast drawdowns compound. 2.5, one bad cycle can cripple the account. And at 3, high probability of account failure. So this is gambling behavior right here. So you don't want to do that. Now, understanding realized losses. This is when your actual losses kick in. Like today, I had a $400 realized loss, and I have like $1,500 unrealized loss. Now, this is important because if you're at negative 5% on your account, you have 95% of your account that's left. But in order to break even, it's not 5%. It's actually 5.3 because of the fees, right? And getting back to that is important. This will be the last point that we talk about here today. Negative 10%, you need 11.1% to get back to break even because there's trading fees and so on and so forth. The higher you go down, like when you go negative 50, right, on your account, you actually need plus 100% to get back to break even. You see how that works? So this is the account, what's left, but this is what you actually need in order to get back to break even. So 59, 143, 65, 185, negative 75 plus 300%, negative 80 plus 400%. And that's why really understanding these multipliers good or bad, and I'm not saying, they're bad. I've seen it where people have made a tremendous amount of money. In fact, there was somebody here at Build that originally out of the box they moved their settings and it was really positive. I forgot what the numbers were, but they had moved their risk multiplier. I don't remember exactly to what setting, but they wound up making quite a bit of money. And then we advised them to bring it back down because at that particular moment in time, and plus it was a GNTX funded account. So it did really well, but it was very, very risky. And so had it gone the other way, it would have been very devastating for that account holder. So we advised them to set the right settings for that account. And so everything that I just talked about right now applies to a straight equity account. When you have a funded account, well, that just makes it that much more riskier to do. Okay, now going to the last thing that I want to talk about, that this is a perfect lead-in. When you see an account, see whatever the balance is, right? 2,000, 2,500, whatever it is, and you see a 0.01 trade being executed, whether it's a buy, whether it's a buy or whether it's a sell. And if it doesn't go your way, the system is going to do what's called a grid hedging positioning is what it's called. Grid hedging positioning. And so what that is, this is not a martingale. So before you guys even ask, it is not a martingale strategy. Okay. However, it's going to look at those trades. And let's say you wanted to go back to break even or close out with profit. Let's say you have two losing trades, 0.01 each, 0.01 each. The system, and this is a broad example, okay? It may not be exactly the way I'm telling you, because I'm rounding up or I'm rounding down, right? But I'm trying to give you an understanding of what the system's going to do. And I'm talking specifically about the gold alpha. It's going to add those up. It's going to do the math and it's going to say, oh, well, if I open up a position in the opposite direction that totals these particular positions that were in loss, then I could hedge my way back out into break even or even to a positive scenario. So right now, what the system is looking for is an opportunity to hedge on the drawdown that was carried over a few days ago to take us all back to break even or to profit on that particular hedging strategy with that particular trade. And so typically the gold alpha closes out positions every day. That is no longer the case because of the scenarios that we encountered in the market. It allowed for us to not get closed out, but to carry a P&L, right? A floating P&L, which is an unrealized loss. What does that mean? You're still in the trade, you haven't lost, but it can affect how many positions you go into, because if you have a tighter account balance, if that $1,500 of unrealized loss, then that means there's only $3,500. And if those are already in open trades, then how much you have in order to keep going could be affected, right? So those are considerations. But my whole point here is if you have 0.01, 0.01, 0.01, and these are all negative positions that you happen to find yourselves in, and the system puts in a buy at 0.04, well, guess what? That 0.04 will cover the 0.01, the first three, and then add some profitability. Now, that's or break even, right? Is really what it's trying to do. Now, does that work every time? No. And that's why we've seen some losses that have, people have asked, well, why is it taking on a small account this particular amount of position lot sizing? That is why, because it's a hedging strategy. It's called a grid hedging positioning strategy to get you out of a bad trade. And so because of the instability of the market, we've had some losses. Today we took a loss. I took a loss of $400, and I'm sure everybody else did too. That's running the gold alpha. And this is where you need to decide whether or not you're able to stomach when the going gets rough, right? Because trading as a whole is already tough, but then when it goes rough, then it's something else. Now, let me show you this, okay? This is an account that is, let me see here. Let me refresh it. I want to make sure that you guys could see it. This account started when did it start? In December, right? So December 14th, so January, February, March. So this is about a 3-month account, and it's gone up $1,251. Okay. Very steady. It's uh, slow and steady wins the race, right? It has an unrealized loss of 898. So this is not a loss. This is a position. Now this was up to like $1,500 a few days ago, and it's tapered down, tapered down, tapered down. So these are positions that are now closing, that are swing trades, that have gotten, into a profit scenario or a break-even scenario, or some even have been a loss. But they're unrealized losses, right? So the money hasn't been lost. It's still in a negative position, but could come back to break even or even profit. Now, this is a slow and steady wins the race type of account. Okay, so on 5,000, 10% would be what, $500. This is 3 months, so 1,500. So it's a little shy, right? Because remember, this particular algo is not the gold algo. This is the GNT, the Algo Alpha X algo, and it's done probably about 6 to 8% a month. Okay, very slow growth, very steady, but doesn't have all the risk that some of the other strategies have. Like for example, the crypto algo. That one has an emotional roller coaster ride. It is the most profitable outside of the gold. It is the most profitable, but you need $25,000 to run that thing, right? So it's not for everybody, and it's certainly not for the faint of heart, because last year in 2025, I think it lost 4 or 5 months out of the year, right? So, and then all of a sudden it comes back in January and makes in 1 month 80 grand, right? Or whatever it was. So it just depends on your risk tolerance. This is something that if you don't want the roller coaster ride, if you don't want the big swings or the big wins and the big losses, then this is still a product that you can use. Now, the only thing is you need a minimum of $5,000 to trade this particular algo in order for it to be working optimally. With the gold alpha, here's what I would suggest. 2 things that we're doing. One, we're looking to increase leverage on the GNT side. So we're already in communications, we're already providing documentation, we're already providing all the needed things in order to increase the leverage of GNT. On the funded account, it's 10x, but on a standard account, if I go back to my other account, okay, let's see here, continue. So if I go to this account, if you notice, the leverage here is only 200, 1 to 200, okay? We are in communication right now with GNT to see if we could increase this by 1 to 400. Now, I know that we have some people that are from other parts of the world. In fact, we have a team now in New Zealand. They have the ability to go open up an account with whoever they want at 1 to 500 or 1 to 1,000. Now, why is that important? Because when you're following a master account that has higher leverage than your own, then the triggers are going to be a little bit different in terms of drawdown, in terms of accounts settings. And so that's why we want as much leverage as possible from GNT. Or if you're outside of the US, then you can go to any broker that gives you higher leverage. And that would also mitigate some of the risk. Now, on top of that, what the system will be doing moving forward is it's going to concentrate 100% of its trading activity on buy orders. So buy orders, you're looking at 80% win rate. So, in fact, it's gotten as high as 85% win rate on buys. So, for the foreseeable future, in the instability of the market that we have right now, we're going to be focusing on buys for those of you that are trading the gold alpha. So, a couple of things. One, we want to increase the leverage. We want to focus the trades on the highest winning probability trades, which are the buys. And we want to make sure that everybody has a proper risk settings in their portal, so to minimize risk and protection of capital if you wish to add those equity protections on your account, which is what we covered here today. So I know it's a lot of information. All of this is recorded, and Robert does a much better job to systematically go through all of this information in the back office. This is a crash course and kind of a water hose of information that I've just given you. But again, we have 5 different algos that you can choose from that are algo trades, right? And then we have other traders that have come on board to actually do manual trading. But of the 5 that we have right now, we're looking at a 6 to add to the roster. We have different flavors of risk with all of these algos that you can take advantage of. This one right here, it's going to be high risk, high reward. The other account that I just showed you, this one is slow and steady wins the race. 2.5 years, had 1 loss. So in what is that? 24 and 31 consecutive months, it had 1 loss, 1 month that lost. And if you look at what that percentage was, that was at 0.66%. So that's also worth noting. And this, I promise this will be the final thing that I talk about, and then I'm going to shut up. But if we go to here and we look at, let's see, is this it? Let me see. If we look at the percentages here, okay, and the drawdowns, we'll look at Algo Alpha X. It used to be 5.8, and this is something that I want to make very clear before we log off here. And I've had people say, "Wait, I thought the max drawdown was 5.8, right? Or in the Gold Alpha 10.8." And what they're really saying is, how come I lost more than that when the max drawdown was this amount? So I want to address this, okay? Just like this particular product, which is our most conservative product, on straight equity, it's only making 1.88% per month. On the drawdown is doing 6.24. Now, this number used to be 5.8. Okay. So what does this mean? It means that in 2.5 years of history, okay, if you go in here and we look at 2025 and we look at all these months and we look at 2024 and we look at part of 2023, and then now we have these months here. So in January, it lost 0.66%, which is nothing, okay? It's nothing. I mean, 0.66% is nothing, right? So, but what the drawdown means is that it adjusted from 5.8 to 6.24. Why? Because the drawdown now went further down. Okay, a drawdown doesn't mean you're going to get out of a trade or it's a protection, a maximum protection. All it means is, look, in this period of time, the statistical average of every month, and looking at all the losses and looking at everything that went wrong, up until today in the present time, this is the maximum drawdown that this account has had. It doesn't mean it doesn't have the potential to exceed that. It just means, look, if you're going to make an educated decision for yourself, this is the max drawdown that this account has had. That's all it is. Can it go past it? Can it go past 6.24? Absolutely. Tomorrow we might have some kind of an event. This trades, different things. It doesn't trade the Let's see, let's go to maybe trading activity. Is that where it's at, or where is it? Let's see. Advanced statistics, trade summary. Let's see if this changes. No, that's not what I want to look at. I'll have to show you. Let me see. Maybe drawdown, margin. No, that's not it. Anyway, bottom line, we're talking about drawdown right now, and so the drawdown can increase. It's just a metrics that is telling you what it's done up until this particular point in time. So this 6.24 doesn't guarantee that at 6.24 that's your maximum risk. It just means that at this point in time, the maximum risk that has happened averaged over the data that we have, which is 2.5 years, or now it's 2.5, or whatever it is, right? It's more than 2.5 years. But that's what that means. And so when the gold alpha took a hit and people were saying, wait, I thought it couldn't, it was 10.8. Well, yeah, up until that point in time, that was a maximum drawdown that it had. So it was a very safe pre-war system. And so, that's the reality of it, that at that point in time, yes, it had been 10.8, but can we go past that? Absolutely. We just saw it. We just lived it here, and we also lived it with gold alpha. And so I'll shut up now and open it up to some Q&A, and I'll stop sharing here. Oh, no. I'm going to share one more time. I keep saying I'm done, but then I remember something else. So let me share one last thing, and then I promise I'll shut up. Okay. Let's see here. Let's go here. We're going to click here. And the reason I'm clicking here is because this is going to show you what this particular product, when they added all of the new AI to this particular strategy, it started in November of last year. So you saw 14.5%. You saw 35.21% in December. And then in 2026, you saw 57.45 and 56.44. And before that Black Swan event, we were rocking. I mean, we were making, just amazing returns that were just, incredible. But what I'm trying to show you right here is timing. Okay, so let's see if I can grab a calculator. Oh boy, no, I can't do it that way. Let's see. I need help. I need somebody to help me from the audience here. Okay. So if somebody could do this for me, add 14.50. Take your calculator. Well, I have a calculator here. I could do it myself. Let's see. We're going to do, and you can follow along, 14.50 plus 35.21. And then we're going to click on 2026, and then we're going to add plus 57.45 plus February 56.44. That totals 163%, 163.6%. Now, I'm not even taking all of 2025. I'm just taking from where the new AI was put into the system to now. Okay. So if you deduct right now where we're at, negative 65.92, you're at 97.68%. Okay. So hopefully, yeah, 97.68% still positive. So my whole point here is not to minimize what we're going through, guys. I'm not trying to minimize the losses. I've taken some massive losses here, right? But again, I lost half of my net worth in January when Bitcoin dropped by 50%. So it's like, I'm over it, right? It's like, what's next, right? So it's like, You know, again, it's not to minimize, it's just to give you a different perspective on what this is. I mean, if you don't want any loss, then you can put your money in the bank where it gets devalued by the rate of inflation each year, and your purchasing power by leaving your money in the bank is depreciating by about 9% per year. I mean, that's just what it is. Plus, on top of that, whatever checking fees and you have. You don't want that? Well, go put it in a bond, and that's a little better. Or go put it, in the S&P, where you're going to make, maybe, 11% a year, right? 12. I put $1 million into an S&P account, and I think that's what I made, about 11% for the entire year. Okay. Um, so, but if you want to look at this from a very objective, kind of like, we're right now in the circumstance, right? We're living the nightmare right now. But if you head, if you zoom out, right, and you say, wait a minute, had I started in November, would I really be up in arms right now? No, but there's the events that are happening right now where literally the war is happening, people are dying, money's being deployed, markets are being manipulated. Gold is doing exactly the opposite of what it should be doing in a time of war. It should be skyrocketing, but the more the gold skyrockets, the more the U.S. dollar goes down. And historically, when we're in a recession or a depression or something's bad with the economy, and I said this, and I don't know if I said it to anybody here, but in private conversations, I said, look, we're in a bad spot as a country. Watch. The next move is declaring war on somebody else. That is the go-to move. Okay. That train is never late. We go to war. Okay. That's it. And that's what we're seeing. We saw going to war make gold go down, which is stupid. That's not what gold does in time of war. It goes up. So we're seeing all of those things. Now we're worried about oil prices, right? And that was just today, right? So it's not a normal market by any stretch of the imagination so, but again, that's, those are words, right? That doesn't give you your money back, that doesn't put money back in your pockets, it is what it is. But it is an explanation for you to say, hey, you know what, this might be too risky for me to trade. Maybe I want my money in the algo X, right? I just showed you it's doing well. So even with the loss that we took in January, which was a small loss of 0.66, it's still doing phenomenally well, right? Now, it's not nowhere near the types of returns that we can see with the gold, but maybe it's time to shift over to that, let things stabilize a bit, and then you could come back once the market conditions are adequate for something that's a little bit more riskier and more profitable, if you will. So that's what I wanted to show you. Again, not to minimize the nightmare that this last 2 weeks have been, but to actually give you a perspective of what the possibility is, because we have happy customers that started in November that are like, okay, well, that happened, but let's go. What's next, right? And so that's just to give you that different perspective. So please, I'm not minimizing anything, but it is what it is. Okay. So now, I promised I'd shut up, so I'm going to shut up, and I'll open it up for some questions. And I said a lot, so Eddie, go ahead, open up your mic.
Hey, Mr. Pacheco,
Yes,
you're
sir.
doing well. Hey, question. So, can I have more than one account open? I ideally would like to have one account for Go Alpha and the other one for the crypto and so forth.
Yes, you can. Absolutely. Now, if you're in the elite package, you could have up to 3. And if you're in the premier, you could have up to 7.
All right, so 7 it is. Sweet. I just need to start stacking cash. Hey, and
Yes,
second
sir.
question. What you said when you were saying earlier about 10 minutes ago, 1.8% on the gold alpha per month? You were
No,
talking
that
about
that was on the Alpha X trader. Now that 1.88, just so we're clear, okay, just so we're clear, when you're in a funded account, that 1.88 multiplies 10x, so it's about 18%. That's been the average of that trading product for the past 2.5 years.
that has been the monthly return. Did I
Correct.
understand that correctly?
Yes.
And what you said another, you said another number, 0.88. What was that? Or something? Or
0.66. That was the 0.66. I said 0.66 was the loss that we took in January. So less than 1% was lost in January on that one. That's an extremely conservative, extremely product. If you run that on straight equity,
Yeah.
you're going to have like a drawdown of, well, up until this point in history, the drawdown has been 6.24. In January, it was 5.8. At the end of January, when we took that loss, it went to 6.24, whatever it is, right? Which is still really, really good for any type of algorithm. But the average monthly profitability of that product for the last 2.5 years has been 1.88 per month. But when you combine that with a funded 10x account, those percentages get 10x. So you're looking at about 18%.
Copy that. Thank you.
You're welcome. Amanda.
Hi, Mr. Pacheco. I have a question because I just realized I did mine the wrong way. When you did for the equity monitor, I did 20% instead of putting the 80. How do you go back and fix that? I just looked in there and I tried to hit and it doesn't let me change it at all.
Okay, so let's go there. Let me share my screen. Give me 1 second, please. My computer is not cooperating. Give me 1 second here. Again, I hate doing these trainings when I'm not at home because I usually work off of a very large computer monitor and I can see, and like here, it's hard to see on this laptop. Plus, it's old. Okay, so we're gonna go here. Can you see my screen?
Yes.
Okay, so we're going to go to your dashboard. So we're going to go to Algo,
it was the goal.
algoalpha.co/dashboard. Or if you need to log in, you're probably going to have to go to app.algoalpha.co and then log in and then get to your dashboard. And to get to the dashboard, all you have to do is go to the left side and this little icon of a dashboard. You click on it, go there. Then you're going to scroll down to configurator. I don't even know if that's a real word, but it's called the configurator. Sounds like one of those Acme weapons or something, like the disintegrator. But you go to equity monitors. So when you click on configurator, you go to equity monitors. And then you create the equity monitor. If you already created one, you're going to go here. You're going to select the account. In this case, I would select this account. Select type. You're going to go to protect percentage. And then you're going to put the percentage in here. So if you want it to trigger a kill switch, if you will, and protect 80% of your account, then you would put 80% right here. So at 20% loss, then it would protect the rest of your capital, which would be the 80%. So it's kind of a little backwards there. So I'm glad that you're asking because it's very easy to do it the other way.
Yeah, I did that. I did it the wrong way. So now I'm trying to fix it, but it won't allow me to change the protect percentage.
Are you logged in to your account?
Yes, I am.
You probably have to delete that one and add a new one.
Oh, okay. All right.
Oh, okay. All right.
Thank you.
You're very welcome. Thank you, Chris. All right. Next question. Let me see in the chat. See what we got going here. Two. And if I'm missing Acme trading account. Hey, are we able to close out trades Alpha Gold ourselves since it was up 487 plus rather than Alpha ended up losing and closing all trades? Yes, you can. You could go into your MT5 and you could close out any trades whenever you want to. So the short answer is yes, you could go in there and close out those trades whenever you want. Any other question here?
Hello, sir. My name is Laura Johnson. I have my hand raised. So,
Hi, Laura.
hi, sir. Thank you so much, first of all, for bringing so much clarity to what's happening. You know, it really is a matter of perspective, and you've really been able to help me to expand my perspective and understand it a lot more. My question is somewhat about closing out trades. I know when you were speaking about the grid hedging, and so
Yes.
the algo is setting up opposite trades, so to speak, to hedge against the ones that may be losing at the time. So is it advisable to interrupt that process and close out trades when they're in profit, or is it advisable just allow the algo to do what it's doing so that it can offset those losses? So that's my question, sir. Thank you.
Very good question. Again, the answer goes back to your risk tolerance. And so that's going to be different for everybody. So it's kind of like one size doesn't fit all, right? If you ask me what I would do, if it's a me question, and again, I don't want to influence you based on me, but I just was very transparent right now. I told you I lost half of my net worth in January, and that doesn't keep me out of the market. So so I'm a very high risk tolerance kind of guy. So, if it's me, I'm going to tell you, I'm going to let it ride because I've seen what it can do. And so I want to catch it on the upside as much as I'm taking the downside. I want to be there for the ride. Right. So, but that's me. That's a very extreme case. I'm like not suggesting you do what I do at all. You have to do what's right for you, Laura, and maybe putting those settings at 20% or putting or closing out some trades that you feel like, man, I'm gonna grab this profit right here, right now, might be the best thing for you. I cannot answer that for you. So
Okay.
you see what I mean? Because it's just gonna one size doesn't fit everybody.
Yes, sir. Thank you so much.
Yeah.
Appreciate it.
Yes. We have a newbie here talking about MT5 and closing trades. Where do we find our MT5? Is that in algo? That's a whole other training, guys, to go into MT5 and showing you how to close out trades. There are videos in the back office, I believe, that cover this. Next week we could cover that. At this point in time, I already got a doorbell ring here. I have to check out. Checkout's at 11 and it's 11:14 and I'm still on here with you. So I have to pretty much close out my session here. I didn't realize it was that late, but I do have to check out of this hotel room to head back home to California. So I apologize, but we're gonna have to cut our training here a little bit short. Not short. I mean, we've gone for about an hour and 14 minutes. So but I'll put that on the list for next week so that we could go through MT5 and how you can actually go in there and close positions out. Now, I will say this. If you're going to be doing that, then maybe this isn't the product for you. Maybe your product is to learn how to trade for yourself. And so that way you can manage your trades manually. Now, that doesn't mean that it's a bad idea to go in there and manually change things. But if you're going to do that and you have the time to monitor this in that way, then trading your own money is always the best thing that you can do. So but yeah, we can definitely go through with MT5 on how to close out positions as they're happening. So, but that'll be a next week kind of thing. So thank you so much. If I didn't get to everybody, oh, Ilana, I'm sorry. I didn't realize it was you asking that question. So, privately, I'll show you over the weekend, Ilana, how to do that. But yeah, good morning. Good to see you here. Ilana's in New Zealand, and so she's one of our newest team members here. So anyway, folks, thank you so much for being on here. I see another raised hand. I don't want to ignore you, Amanda. If it's something quick, please ask your question.
Yes. I was just going to ask, if we close out the trades manually while they're in profit, is that going to mess up the actual trader from taking new trades?
No.
Okay, perfect. Thank you.
Yeah. Okay. All right. Well, thank you so much, guys. And in the chat, if I could see, was this helpful at all for all of you? Okay, great. And you guys know where to find all this information in the back office, right? I showed you that at the very beginning. So if you got here a little bit late, all of the information that I covered today, including the visuals that I showed you, are in the back office as well. You just have to sign in if you're at the elite level or the premier level. You go to the Build Academy, and then you start scrolling down until you find trading education, or I forget what the topic is, but it'll show you there the education, and there's about at least an hour or in 45 minutes, maybe 2 hours of training specifically on most of what we talked about here today, and including other things as well. So have an incredible rest of your day. I'm going to try to check out here before they get security on me, and I'll talk to you guys soon. God bless.
Thank you.
Recording